Welcome to the Aramir Roundtable. Today is 18th of July, 2019, and I have a special guest, Ophir Gottlieb from CMLViz. So welcome, Ophir. It's nice to have you.
Thank you, Tom.
And just a bit of an overview. I've been looking at the trade machine for several years, and when I first looked at it, it was fairly basic, but over probably the last year especially, it's really grown and developed, and you have the alerts now and everything, so it's really turned into a really wonderful research tool, and an alerting tool. So we've had a lot of people in our community talking about it in our trading groups, and a few people signed up for your special offer, so thank you for that.
Sure.
And yeah, we're really excited to have you here. I'll put myself on mute in case our parrot's making noise. It won't interrupt, but I'll still be here. And yeah, just nice to have you, and take it away.
Awesome. Thanks, Tom. So for everyone here, thanks for joining. I'm going to do don't worry, the disclaimers are not going to be long. It's 3 slides. And then I'm going to talk about option trading. And I'm gonna show you how to find trades, okay, that you may like, how to set alerts for them. And then I'll go backwards and we'll look at the actual triggers that we set these alerts for. So it's gonna feel a little bit like Alice falling down the rabbit hole at first. You're gonna see all these things and say, this is amazing, but I have no idea what trade are you talking about? And then we'll go backwards. So it's going to be a little bit of live presentation, mostly live presentation, and a little bit of like short vignettes, a little bit of movies that I'll play. But let me just start with the important stuff, the disclaimers. So this is not a solicitation to buy or sell any security ever, right? And this is an advice. In some sense, you could say this is sort of the opposite of advice, because we're just showing you, scientifically observable fact. We're showing you phenomena, and then we're going to talk about those phenomena. The results here are provided for general information purposes as a convenience to the viewers, and the materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. And my final slide, and then we'll get to this good stuff. It talks about trading futures and options involve the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation, of course. And only risk capital which should be used when trading futures or options, and investors could certainly lose more than their initial investment, as we all know. Past results are not necessarily indicative of future results, and the risk of loss in trading can be substantial. So carefully consider the inherent risks of such an investment in light of your financial condition. Okay, and finally, anytime you talk about options, you're supposed to talk about the characteristics and risks of standardized options. Disclaimer, if you go to theocc.com, you'll find it there. So I'm not going to show the entire document, but when you talk about options, it's a disclaimer that you should just note that there's something called the characteristics and risk of standardized options, and that's how you can find it. Okay. I'm going to give, let's see here. Oh, I see we got chat. Let's see here. Okay, I see some questions in chat. I'll get to those at the end, just so the presentation can feel, congruent.
That makes sense, yep.
Yeah. So when you first log into this magical thing called TradeMachine, this is the screen you're going to see. Okay, it's, actually, I can actually make it a little better. Okay. Yeah, it's a screen, and there's tabs at the top, and there's a bunch of stuff here, and there's this weird pop-out thing here, and there's this weird thing, and it feels like there's a button here, and it's like, man, what's going on? So this is how I use a TradeMachine. So what I'm going to do, what you're going to see me do is set alerts for some trades that I want to do. Okay. And we're not even going to know, I'll tell you roughly what the trigger is, but we won't even know exactly what the trigger is. After we set the alerts and see the results, then I'm going to go to a vignette which shows, okay, what did I just talk about? And then we're going to do that for several different kinds of trades. So there should be something here for everyone, whether you just you like to buy the dip, you like to get long and short bursts of, risk exposure, or short bursts of risk exposure, or, just volatility trades, anything like that. So I'll try to go over various types of trades so everyone gets something that feels like a type of trade they might want to do. So what I do when I see this ever-encompassing and imposing screen is I actually just skip the backtest tab, and I go to the Pro Scan tab, okay? Then I go to Buy Strategy. And for this, I'm going to just choose the Dow 30. No particular reason. We cover every security traded on, the US exchanges, from indices to ETFs to stocks. I just choose the Dow 30. And I want to look at a buy the dip technical trigger. And I'll go in depth as to what that trigger is and why we should even care about it. But for now, I think we understand what it means. When a stock goes down, are there some technical conditions that are met that kind of signal it's going to stop going down and start going up? In fact, I think I have a pretty cool picture. We'll have to go without the picture for now. So I go to Dow 30, and then I go to the buy that this is a trade where you never trade earnings, and that's just a fancy way of saying that if earnings are coming up, you just close the trade. We don't take, you can take earnings bets with the software and test it, but that's not what this is. This is kind of all other times. So I'm going to click buy the dip. And I'm going to sort by the number of wins. And all of a sudden I have tickers and results. So I'm going to click on a ticker. Okay. I'm going to click on Intel. And you'll notice that, so my scanner is still open. It just went to the backtest tab. All it did is another window opened and it went to this tab. And here are the results of this magical buy the dip trigger, okay, for Intel. And then let's remember the five other tickers, or 4 other tickers: ExxonMobil, Cisco, Nike, and Walmart. Right? So ExxonMobil, Cisco, Walmart, and Nike, in the wrong order. So you can do up to 5 tickers at once. This is looking at buying the 40 delta calls, which are slightly out of the money, using 30 days to expiration. That's what this is right here. Okay. Using a 50% stop and a limit when a certain technical condition is met. And we'll talk about that technical condition in a second. Okay. Here are the results over the last 3 years for these 5 tickers. I just kind of scan across and I say, okay, well, ExxonMobil, kind of, which of these doesn't look like the other? Doesn't really look that great. So I'm just gonna remove it. So now I'm looking at 4 possible alerts, but obviously I want to be a little more robust. So this is over the last 3 years. Let's take a look over the last 5 years. Okay, so far everything looks great, but when you're looking for back tests, you're looking for things that move in different volatility regimes. And we've definitely been in a different volatility regime in the last year. So let's look at the last year. See, all of a sudden Intel doesn't look that good, right? Intel, 2 wins, 2 losses, 3% loss. So if it works over the last 5 years and 3 years, but not the last year, I don't want it. And when you use TradeMachine, believe me when I tell you, you're going to find enough trades. So the work is to find the things not to trade, right? So you really want to be specific. So in this case, I started my little route of discovery with 5 tickers, and I've actually eliminated 40% of those. 2 of them right away. I just said, no, I don't like it, right? Let me go back to the 3 years. Okay. So if you want to see, what is going on here, these are just numbers, you can just tap on a backtest tab, a tile, okay? And it'll open up all the details, right? So it tells you, this is for the last 3 years, Cisco's been up 110%, the stock, okay? 5 wins, 5 losses, and here's every single trade. So the first trade triggered, and I'm going to talk to you about what the trigger is too. Right now, we still haven't talked about that, but this triggered first time 3 years ago, June 13th. Opened the July 14, 17, 32 calls. So the 32 calls with the stock at $31. So just slightly out of the money, paid 32 cents. And 13 days later, here we go. That trade closed out at 58 cents. Okay. And then this is the next time, and you can keep going. And you can, of course, download this into Excel or copy it onto your clipboard and then put it into Excel if you like it. That's, I actually like this better. It's faster. So you can see every single trade. There's no black box here. You can see exactly what's going on. Okay. So let's say we're sufficiently happy with these 3 trades, even though we still have no idea what the trigger is. And you say, you know what? This happens when certain technical conditions are met, and I'm not going to be able to watch the market for 3 stocks, not to mention, probably the 150 that we're going to look at. So I click the add alert button, and you'll notice that my scan is still open. My backtest tab is still open, and now I'm on the alerts tab. Okay. So we're just moving across this, and it's for these 3 tickers. Okay. It's a technical alert, and these are the requirements, and I'll go over these more slowly. You don't have to kind of read this code. Okay. I'm gonna, actually, you know what I'm gonna do? I'm gonna do one thing, sorry. Actually, it's fine, sorry. I was gonna, all right, so I'll go to add alert. Oh boy. Okay. Oh, sorry guys. I wanted to log out so I could clear the alerts and show you them working, but I figure we all have the imagination to make it work. I think it was Walmart, Cisco, and Nike, right? Yeah. All right. So I'm going to click Add Alert. Here are the three. You can put your phone number in, right? And then click Add Alert. And then 3 alerts were created. Okay. So now I will be alerted when those, I haven't showed it to you yet, but whatever those technical requirements are met, I'm going to get alerted during the day via email and text. So this is how you would use TradeMachine for almost any trade. And now that I've done that, I owe you an explanation of what we just looked at. So I'm going to go to the Discover tab. Okay, so this is now finally the final tab, right? We went from the scanner to the back test to alerts to Discover tab. And let's take a look at what this buy the dip trigger is and why does it matter? Am I just, cherry picking the times it worked in a couple companies and pretending that it's, robust research, or is there robust research behind this analysis? So I'm going to play a video. It says 11 minutes, but it's not, because the last part of it just shows you what I just showed you about adding alerts. So it's probably about 5 minutes. But when I do this, I'm going to run a little test. So I'm going to play it for about 3 seconds and stop. And I want to make sure I'm not playing a silent movie. So I'll let Tom tell me if he can hear it. So I'm going to hit start.
I hear it.
Today we will discuss, define, and be explicit in our rigorous testing of the buy the dip technical trigger. First, some disclaimers. This is not a solicitation to buy or sell any
disclaimers again.
The reviewers are not for our hypothesis. Here we go. And how the signal compares to the baseline. We will liquidity and slippage. Okay. Here we go. By the time this webinar is done, you will see the exact technical settings that have shown a buy the dip opportunity and how the signal compares to the baseline. We will see actual examples with charts and results. We will see the results in the scanner. But we make a note. Buying the dip is only a good idea if the stock goes back up. Otherwise, it has a different name. It's called buying a losing stock. We're focused not so much on buying the dip, but more on when to buy the dip. Let's define what makes a good trade candidate. We want a win rate that shows more wins than losses, and most importantly, we want to see an average return that is greater than the baseline. There's no use in using extra analysis or technical triggers if the result is a strategy that doesn't beat the baseline bullish strategy of just buying a call every 30 days. For some quick definitions, for the 10-day and 21-day moving averages, we're using exponential moving averages. And for 50-day and 200-day, we use simple moving averages. For RSI, we use a 20-day period. Here's the idea behind the trigger. When you use charts and with them technical analysis, you're using the most common form of financial backtesting. A stock chart is history, and therefore at every step, using historical data and trying to draw conclusions from that and patterns in the past to extrapolate in the future is a backtest. Our idea, let's identify a trading truth one way or the other. Either there is a combination that meets our criteria for a good technical buy the momentum trigger, or there is not. We enter with no bias, and therefore we enter with no cognitive traps for bad trades. The setup will look like this. Our research looked at the last 1 year, 2 years, 3 years, and 5 years of returns. We used the NASDAQ 100 as the study group, that is the constituents of the NASDAQ 100, and after tens of thousands of backtests, we landed on 3 technical settings for this buy the dip technical trigger. We wait until the day that the stock price crosses above the 200-day moving average from below. That means the stock has been in technical failure up until that point. We want to see the stock price is already above the 10-day exponential moving average, because that indicates to us that some short-term momentum has been confirmed. Remember, we're looking to buy the dip if the stock goes up, not to buy the dip. We want to make sure that the RSI is below 70. We simply want to check that the stock is not overbought. Of course, in this technical setting, it's quite hard to see an RSI above 70 if the stock is just now crossing the 200-day moving average. A few other settings, we use 30-day options to give the trade time to make its move, and we use a 50% stop and limit. Here it is in all of its glory with a snapshot from TradeMachine. We want the day that the stock price crosses up the 200-day moving average. That's an active trigger. The stock must have been below the 200-day moving average the day before and above it on the day of the trigger. The stock price is already above the 10-day moving average and the RSI is below 70. Now, if we look at the buy the dip technical trigger and the results using the study group, the constituents of the NASDAQ 100, First, we look at the average return. That is the average return of all of the trades per stock. Over a 5-year time period, just owning a 30-day call and rolling it every 30 days and avoiding earnings yielded 5% per month. Using the buy the dip trigger yielded 10% per month. Over 3 years, we saw a 7% return on the baseline. But using the CML buy the dip technical moving average trigger, we saw a 16% return. Over the last 2 years, we saw a 5% baseline return jump to 24% per trade per month on average using the buy the dip trigger. And over the last year, the baseline returned to 6%, while the model returned to 23%. Notice how consistent the baseline is. That is, buying a 30-day call and never trading earnings and rolling it every 30 days has returned about the same amount monthly over the last 5 years, no matter how you slice it. Yet when we look at the buy the dip trigger, we can see significant increases in returns above the baseline and increases in returns as we come closer to the present, because a buy the dip has become a bigger part of the market, because politics, interest rates, and tariffs have become a bigger part of the macro narrative, and therefore there are much more abrupt dips and, when you get it right, much more abrupt returns off of those dips as the stocks rise. When we look at the win rates by stock over a 5-year period, 67% of the stocks in the NASDAQ 100, when you take all of their backtests into one bucket, showed winning returns. That win rate stayed above 60% even as we got down to the last year. So we have seen substantially higher average returns relative to the baseline and substantially positive win rates. Exactly what we intended to see if we were to decide that this trigger was in fact robust. Even further, when we looked at the rigorous testing of the buy the dip trigger, we found this. Over 5 years, if we just took the constituents of the NASDAQ 100 and rolled a call every 30 days while avoiding earnings, we saw 6,769 trades. But if we only bought that call when the stock had dipped and was showing a recovery from technical failure per the model, 85% of the trades were avoided. Over the last year, 80% of the trades were avoided. This trigger yields substantially higher average returns, substantially high win rates, and avoids substantially most of the trades without it. Of course, the past is no guarantee of the future, but at least we now have a rigorous, empirical, and explicit result for a buy the dip trigger. We can go to the Pro Scanner, go by strategy.
So the rest is just me going over setting alerts. So that was the buy the dip trigger. Fear not, you don't have to memorize it. You can just click on technical open, and here it is. All right, so this should also show you that you can test anything you like. These are from one scan, but you don't have to fall within our scans. If you have ideas that you want to try yourself, it's as easy as clicking a button on and off and a drop-down menu. So this is the buy the dip trigger. And we can look at, I just looked at the Dow 30 and the first 5 names that I saw. You can look at the NASDAQ 100 and sort by the number of wins. And then you're going to see Starbucks and Gilead and Google and Workday, whatever. So that's how, and of course, if you want to do the entire market, actually, I'm going to show you one example of where just seeing results isn't quite good enough. So let's say I did the NASDAQ 100. I'm still looking at buy the dip. And I want to look at, the next 5 companies. Okay, so WLTW, Starbucks, we know Intel isn't good, right? So WLTW, Starbucks, Gilead, and PayX, good enough. So, Starbucks, Starbucks is a good one. Okay, so here we go. And all of a sudden you can see some red font on your screen, and this is great. What it's telling us is that for WLTW, the 40 delta calls, so these slightly out of the money calls, had low liquidity. So, and therefore the results are probably unreliable. And we actually give an example. For example, in December of 2018, the $150 strike option was $1 at 580. Okay, nobody's going to trade an option that's $1 at 580 wide. That's just not realistic. So TradeMachine tries to find those for you and get rid of them, but we let you make your own decisions. At least we give you a warning. So I'm going to delete. I'm going to delete WLTW and then examine the next 3. Let's look over the last 5 years. Everything looks good, right? And then we look at the last year. Starbucks is really remarkable with this trigger. All right, so this is another one where I'd probably add all 3. You can make an argument not to add Gilead because it's a biotech which moves mostly on weird news about partnerships. But you know, if you're using technicals, that's all right. And again, we just got long, a call. We never traded earnings. We used this technical open, and this was our stop and our limit, right? So again, you could add the alerts. Okay, so in pretty short order, I've shown you 6 trades that I would do when they trigger, and how I found them. Okay, let's go ahead and move on past this trigger, and let's talk about something else. This next subject I want to talk about is sort of near and dear to my heart. I'm going to bring an image here. Can you guys all see this this image I dropped in?
Yep, we can see it.
Cool. So there is this phenomenon that we've discovered that's lasted throughout the Great Recession, so back 2007 all the way through today. It's a truly remarkable phenomenon, which is this pre-earnings optimism. So it has nothing to do with whether a company beats or misses earnings, or even if they have a history of beating or missing earnings, actually. But in particular in technology, in the days leading up to earnings, whether it's 14 days or 7 days or 3 days before earnings, there does tend to be this kind of crawl up. And why is that? Well, it's obviously institutions, well, I shouldn't say obviously, it's likely institutions bidding up the stock in an anticipation of a potential earnings beat, right? So that has impact on option traders, which is that as the stock goes up, owning calls into that event has proven to be remarkably good. And this is one of my favorite trades, if not my favorite trade. And so let's look at that. So close everything out, go back to the Pro Scanner, and we can do the Dow 30 again, or NASDAQ 100, S&P 500, doesn't matter. And it's down here. These are pre-earnings trades. And it's a 3 days before earnings, 7 days, or 14 days. But we actually have a technical safety valve, which you don't just get long a call 7 days before earnings. You get long a call 7 days before earnings as long as there's a technical requirement that is met. We can sort it by the number of wins. And we can see Microsoft, Caterpillar, United Technologies, et cetera. When you see a company repeat, it's because this is Caterpillar's 3-year test, and then this is Caterpillar's 2-year test. Let's actually do the NASDAQ 100. So let's look, there we go. Let's look at, just again, to go from the scanner to the backtest tab, you just tap on a ticker. The scanner stays open. Here's SNPS, Texas Instruments, Microsoft, Google, sure. Okay. So again, we get a little warning here. Hey, TXN doesn't have the liquidity to really rely on these results. So, which is to say they're accurate, but there's probably no realistic fill. So let's just delete it. Okay. So this is over the last 3 years. Can certainly look over the last 5 years, right? And then over the last year, it's pretty good. What are we doing? You click on custom earnings to see what's going on. We're opening a position 7 days before earnings, and we're closing the position 1 day before earnings, right? So this does not take an earnings bet. Right? This is not an earnings bet. This is a bet on the momentum right ahead of earnings. We have the ability to test what happens in the earnings event too, but that's not what this is. And remember I said there was a technical safety valve. So you don't just get long when a stock's collapsing like in the fourth quarter of 2018. The technical safety valve in this one's actually pretty easy. The stock price just has to be above the 50-day moving average, right? So you wait for a week before earnings. As long as the stock's above the 50-day moving average, boom, you get in. And if not, just wait till the next quarter. So if you like these results, you can see Microsoft's been pretty weak in the last year, so maybe you'd want to remove it. Yeah. Again, this is all personal preference. And if you have any favorite stocks you like to trade, like I like trading Twilio and Trade Desk, for example. You can just add them and test on the fly. Right. Looks like Trade Desk isn't great with this, so there you go. And if you want to add these alerts, you just click Add Alert. You would put your phone number in here, and you get the same thing. You would add 3 alerts, and then whenever it's 7 days before earnings for any of these companies, and the stock price is above the 50-day moving average, all of a sudden, you're going to get an alert, text, or we're going to get an email and or a text that'll say, hey, now's the time. So everything in TradeMachine uses end of day pricing or near end of day pricing, 15 minutes before the close, because that's when there's the most liquidity. So anytime you get an alert, or anytime you've found your own strategy that you want to try, if you want to mimic the rules of the TradeMachine, then you're looking at 15 minutes before the close. A lot of people say, well, what if I do it in the middle of the day or early? We don't really know, but we have no reason to believe that, 10 o'clock is any different than 12 o'clock is any different than 15 minutes before the close. There's no strong data that we've seen that proves that. But since this is a back tester, we need to be rules-based. And so by rules-based so that the methodology can be followed. So the methodology here is end of day. Okay, now I didn't really talk that much about the pre-earnings momentum. I think you know what's going on, but I mentioned how powerful it was, and I didn't really get into it. So I won't show this video, but there's something that you should know about, and this is behind our paywall and password protected. There's something about pre-earnings momentum where you can make the signal even stronger. And I'll just show you what it is and how to do it in TradeMachine. If our hypothesis was that the stock rallies ahead of earnings because some large buyers, say institutions, are getting in the stock because of the potential for a beat, it would make sense to test an idea that perhaps this trigger, this momentum right ahead of earnings, is stronger if a company is coming off of a gap earnings, right? So they reported earnings, the stock crushed it, ripped the next day. Okay, 3 months later, here come earnings again. It's reasonable to test, without having any bias, that is this momentum even stronger if this has happened before? And it turns out it is. And this is something that people still are not catching on to. So you can limit the number of trades that you're actually going to end up doing, but have a stronger signal if you look for the companies that have beat big last time and then get ahead. And you can test this in TradeMachine. So I'm going to show you how to do that. Let's just throw up Microsoft and Google. Actually, let's also show some companies which maybe didn't work that well. We'll just go with sort of FANG, semi-FANG. Okay, so this is over 3 years, and so Netflix doesn't look so great, Amazon's okay, Facebook, Google, and Microsoft look great. This is getting long a call, 7 days before earnings, closing the day before earnings. By the way, since these companies all report after the market closes, you could actually, if you wanted to, put a 0 here. So that would be right to the day of earnings, because they report after the market closes, and these options would be closed right before the market closes. So that's one way to play around with it. Up to you. And same technical open. Stock has to be above the 50-day moving average. But okay, here's what I want to do. Let's take a look at custom earnings and you say, well, I like that picture of where the stock beat last time, and then there's more momentum. How do I test that? So it's actually not in beta anymore. Sorry about that. You can click here and say, I only want to do this trade, this 7 days before earnings, if the last time the company reported earnings, that day of earnings, the stock was up a certain percentage. Turns out 3% is kind of the magic number. So all I did is put a check mark, and now you're going to see fewer trades, but you're going to find the places where it's starting to work really well. Right? So in Facebook and Amazon, when does this momentum actually happen? Well, it happens when they ripped last quarter. Then all of a sudden, and again, this is over 3 years. So this is 12 earnings releases, and we're only getting 3 out of Facebook and 2 out of Amazon. But that's because they've only gone up, gapped up 3%. And then next time the stock's been above the 50-day moving average that often. But that's the power of understanding the patterns in the market. And so remember this, 3 wins, no losses, 150%, 2 wins, no losses, 128%. I'm going to take that little setting off again. All right. So now you're starting to see the losses come in. So if you're looking for those higher probability trades, this is a phenomenon which is likely occurring because large money is going into the stock ahead of earnings in anticipation of a beat. That behavior tends to continue or tends to occur most frequently when the last time was a big beat. So that's something else you know about. Now we go into the full details of that. That's actually what I just said in not so many words is a pretty big subject. And so on the Discover tab, right? If you come down here and look to video, furthering critical empirical research, or if you really want to get into the volatility part of it, becoming a volatility master, these 2 videos are for you. So we do education through our videos
and show you why certain scans are in the product, right? Like what is the research behind them? And so this is a phenomenon that has been phenomenally strong, has worked, if you watch the video, has worked perfectly well during the Great Recession. So I want you to think about this. NVIDIA, the great NVIDIA, during the Great Recession was down, I believe it was down 71% from high to low, something like that. Let's just say down 70%. But buying pre-earnings calls, so 7 days before earnings, was up something like 40 or 50%, right? So while the market was utterly collapsing, while the stock was utterly collapsing, just getting long calls a week before earnings and getting out before earnings, even then, institutions were getting sort of this optimism ahead of time and trying to get long the stock. And we show the robust results of this feature in this video. Okay, so now that I've said that, we've gone through the scanner, we've added some. So now we've got some more alerts kind of sitting in the background that we're going to get alerted to. Obviously, trades are starting to pop up quite frequently right now because we're ahead of earnings. So I'm in a bunch of them. The next thing I want to talk about, so we've talked about a buy the dip trigger, right? So that's when a stock has been in technical failure and is now coming out of technical failure. How do we know it's not a head fake, right? And how do we know? Well, we don't know. When in the past has it not been a head fake and has it actually shown a bump, and when has it not? We've got this pre-earnings momentum, and maybe even for a clever, a little extra filter on the pre-earnings momentum, right? Maybe if last time was a big beat, right? And that's why we have here in the scanner, we show companies that were big beats last time, right? So Microsoft qualified as a big beat in April, right? So hypothetically, there would have been a good chance of that momentum. And Facebook, by the way, last time was a big beat, right? So Facebook's earnings is 724. So I got in the calls yesterday, right? In anticipation of this event. Let's look at another kind of trade. So we've talked about technical failure. We've talked about pre-earnings momentum. Let's talk about a trade which just looks for the short bursts of bullishness. It's usually when a stock's getting near overbought, but there's this last sort of like thrust forward. And that's a great time for a short burst of risk exposure, to own calls for a little bit of time and then to get out of the way. And so we call that our bullish technical bursts. Right. So companies where you'll notice that Cisco tends to be a really good trade. It's kind of showing up on every scan. It tends to be a really good trading vehicle. So Cisco, ADP, AMD, actually, interestingly enough, Lam Research, which was on that list, we just had one, and right before the stock went up, here, I'm going to show you a stock chart. Let's go to CMLViz. Also, feel free to go to CMLViz.com. It's free, and we actually have good data. So I can actually just go to the summary on the stock. I don't even have to look at a big stock chart. Excuse me. Last 5 days. This triggered here. Stock was at 191, and it shot up to 200 in just 3 days. So Lam Research tends to be a great one for this. As you can see, over the last 3 years, 8 wins and 1 loss. So again, you would go through the same process, like how has this worked over the last 3 years? How has this worked over the last 5 years? How has this worked over the last year? You know, again, there's Lam in the last year 3 times, Cisco 4 times. It just keeps working and working. So you add the alerts again, right? And you put in your phone number and you add it. Now, the question is, okay, what are the technical settings? And if you're going to tell me that just using moving averages is good enough to find something that's worked over the bear market and the bull market, prove it, right? Because that's a pretty bold claim. So I'm going to show you, just as the last time I'm going to do it, I'm going to show you another short vignette, short movie, before we move on to other types of trading. So I go to the Discover tab, right? And I come down to the bullish technicals. This looks like a 12-minute movie, but it isn't, because there are the end of it goes into TradeMachine and shows you what I just showed you. So this is not a 12-minute movie. It's going to be shorter, but let's go ahead and watch this. And Tom, if you don't hear sound when I play it, just interrupt me.
Okie doke.
We're going to discuss our rigorous testing of technical analysis. But first, some disclaimers. This is not a solicitation advice from AE and slippage. We can, with our start impact, if any, of certain market factors such as liquidity and slippage. All right, let's go. So the point of what we're doing here starts with a simple observation. We've all seen magnificent charts with indicators drawn on them that we can, with our own eyes, see are in fact accurate. We can look at the prior history, look at the lines that have been drawn, but the goal is not to have a pattern drawn on a single chart. The goal is to be able to pick up a pattern that has worked on 10,000 charts, hundreds of thousands of times, over decades. That is the goal of rigorous testing of technical analysis. These are the realities of technical analysis and why sometimes it feels like everyone always has a chart that looks good, but it never quite works when you try it yourself. Today, we stop that pattern of blindfolded technical analysis, and we apply it to millions of data points over hundreds of thousands of backtests to give a rigorous result. In this webinar, by the time we're done, you will see the top performing combination of technical indicators with respect to moving averages and RSI for discovering bullish momentum in short periods of time, and then how to apply it in TradeMachine. Before we get to the results, let's talk about what makes a good trade candidate. First, we want to see the average return per trade substantially larger than the average loss. We want to see the win rate. We want to see that it has won more often than it has lost. We want to see that the average return and the win rate and the average return for a winning trade are all greater than the baseline. We do this because there's no use in using extra analysis if the result is a strategy that doesn't beat the baseline bullish strategy already. Remember, we're dealing with an entity, the stock market, that is up on average 6 out of 7 years. So we're looking for something that outperforms a standard bullish strategy. This is what we're going to cover: the idea, the application, and the results. It's that simple. First, we'll take a quick break for 3 definitions. When we're talking about the 10-day and 21-day moving averages, we are using exponential moving averages. When we're talking about the 50 and 200-day moving averages, we're talking about the simple moving averages. And when we talk about RSI, we use the 20-day period RSI. And here's the idea. Using charts, and with them technical analysis, is the most common form of financial backtesting. Charting is, at every step, using historical data to try to draw conclusions from the patterns in the past and extrapolate them into the future. That is a backtest. Charting is a backtest. At some point, the analysis has to be robust. There does have to come a time when we have to ask ourselves if and when technical analysis adds value to trading. That is, are we doing more than just drawing lines on a chart one at a time? The idea is to identify a trading truth, one way or the other. Either there is a combination that meets our criteria for a good technical bullish momentum trigger, or there is not. We enter with no bias. Here's the setup of our study. We looked at 1-year, 2-year, 3-year, 5-year, 10-year returns, starting from March 2019 and going backwards, as well as the period from 2007 and 2009, which includes the Great Recession. So we have 2 bear markets and a bull market. What we would hope to find is the average return per trade is substantially larger than the average loss, that the trades have won more often than they have lost, so a win rate above 50%, and an average return above 0. That this average return and this win rate and the average return for a winning trade are generally greater than the baseline, and that it works in a bull and bear market. We used the NASDAQ 100 as a study group, and after hundreds of thousands of backtests, we landed on 4 technical settings. First, we wait until the day that the stock price crosses above the 10-day moving average. We call this the short-term momentum requirement. The second is that the stock price is above the 200-day simple moving average. You can call this the we're not in a bear market requirement. Third, we want the 50-day simple moving average to be above the stock price, or another way to say it is that the stock price is below the 50-day moving average. We can call this the stock has room to rally requirement. And finally, the RSI is less than 70. We can call this the it's not overbought requirement. So simply stated, we're looking for short-term momentum. We want to make sure the stock is not in a bear market. We want to make sure there's room for the stock to rise and that the stock is not overbought. That's it. Some other settings we discovered that were optimal. We want to look at 14-day options, so really short trades, and we want to use a 40% limit and a 60% stop. You'll see with the results that having a limit, which is smaller than the stop, still leaves us with larger wins than losses. It just gives us a better win rate. And here are these settings in TradeMachine. We set the stock price crossing up through the 10-day moving average. We make sure the stock price is above the 200-day moving average. We want the 50-day moving average to be above the stock price, which is the same thing as saying the stock price is below the 50-day moving average. And the RSI is below 70. That's it. Now, let's look at the average return. That is the average return across all 100 stocks through tens of thousands of trades, the average of all the averages. And now we'll look at the results. We'll start with 2007 to 2009. This is the period that includes the Great Recession and the rally out of it. We'll see the baseline, which is simply owning 14-day calls with the same stop and limit settings as our model, and rolling it every 14 days, returned -3% per trade on average. Of course, these trades are on average about 5 days in length. Even though we're using 14-day options, they hit their stops or their limits pretty fast. So -3% every 2 weeks is actually rather disastrous. That would be 2 trades a month or 24 trades a year per stock at -3% every 2 weeks. So we're looking at approximately a 75% loss every year using this during the Great Recession. Now we look at the results of our optimized version of technicals, and we see a 6% return every 2 weeks, or as I said earlier, a 6% return about every 5 days since the stops and the limits are hit. And that is twice a month for every year. That's 24 trades a year. We're looking at over 100% return on average. Next we go to the 10-year return, and we can see that these optimized technicals show twice as high of an average return, and this is looking over tens of thousands of trades. Then we look at the 5-year return. We're looking at 11% for the optimized technicals versus 4% for the baseline. And over 3 years, we're looking at 16% versus 7% for an unstructured trade. And over 2 years, we're looking at 18% versus 6%. And finally, over 1 year, a period where the market has actually been down. Remember, 2018 was in fact the end of the bull market, with the S&P returning a -6%. The baseline model returned 1% on average every 2 weeks, which is virtually zero. This does include a 50-cent per contract commission, although it doesn't include slippage, whereas the optimized structured technicals show a return of 7%. Note that during the Great Recession period and the last year where there was a down market, the returns are still quite positive and strong and similar. So we are seeing robustness in the model, which is to say that we are seeing similar results during similar times and outperformance during all periods relative to the baseline. Next, we want to look at the return of the average winning trade. So if we're only looking at the winners, not the losers, how did they do? From 2007 to 2009, the average winning return was 70% with this combination of technicals, and the baseline was 67%. Over 10 years, the average winning return was 85%, while the baseline was 77%. You can see that the average winning return was larger in all years other than the last year. We'll get to that in a bit. That's because in the last year, which was a down market, a bear market, the losing trades were much smaller here than in the baseline, and the win rate was substantially higher. Now let's talk about win rates. From 2007 to 2009, if we look at win rates by stock, 48% were winners during the Great Recession, whereas 27% were winners if you just held calls every 2 weeks and rolled them. Over 10 years, they were about the same, but the baseline did outperform, although the returns were substantially worse here because the losses were much larger. Over 5 years, these technical indicators outperformed on the win rate. Over 3 years, the baseline did quite a bit better, but again, the losses were substantially larger than the winners. And finally, over the last 2 years and 1 year, the win rates were higher. The impact of having this technical trigger is understanding the times when you want short bursts of risk exposure. And as a proxy for how often this is triggering relative to just trading calls all the time. From 2007 to 2009, when you wouldn't want to be trading very much because of the Great Recession, using these technical indicators avoided 91% of the trades. 91% of the time when just buying a call every 2 weeks would have been a trade, the indicator did not fire. So to review, our setup was to look at 1 year, 2 year, 3 year, 5 year, and 10 year returns, as well as the period from 2007 to 2009, which includes the Great Recession. We wanted to find an average return per trade, which was substantially larger than the average loss, and you see that in the average return. We wanted to see a win rate where it was over 50% across the board, or pretty close to it when you get to the Great Recession, which we saw. The average return, the win rate, and the average return for the winning trades are generally larger than the baseline, and that it works in a bull and a bear market. So after hundreds of thousands of backtests, we landed on the 4 technical settings, the short-term momentum requirement, the not in a bear market requirement, the stock has room to rally requirement, the it's not overbought requirement, and we discovered that we wanted to look at 14-day options with a 40% limit and a 60% stop.
Okay, so that is what we mean when we are running the bullish technical bursts. Of course, you don't have to remember that because you can just click technical open after you click a scan result, and there it is for you. It's already set. Right, and so you would go through these, add these alerts if you like how they look,
And the goal here is to build a portfolio of alerts, right? Of various kinds. I'm going to get off being bullish all the time in a second, but we've looked at getting bullish ahead of earnings. We've looked at getting bullish after stock has been in technical failure and comes out. We've looked at this last one, which is bullish technicals, which is kind of this last bump up when a stock isn't quite through its 50-day yet, but it's starting to move with a lot of momentum up. And you set yourself alerts. So we have members who have thousands of alerts. I have like 130 or 150, but I keep adding to them. And, you'll go a week without any trades, and all of a sudden you'll wake up on a Monday or Tuesday and you'll have 6 or 7 trades to choose from. Obviously, if you have 300 alerts, you're going to be getting alerts quite often. But that's the point. The point is to do the work by checking the back tests for strategies that are the most appropriate for your style of trading. So far, I've only shown sort of rather aggressive bullish trading, but I'm going to go away from that strategy right now. You set the alerts and you let TradeMachine watch the market for you. And then you get an alert, and the alert tells you what it exactly was that you had done at the time. And you can, if you so desire, you can follow it and then track your results. Okay, now, so we have the bullish technical burst. We have the exact same research. It's a different trigger, but for bearish technical bursts. And we have the exact same research available on the Discover tab. So this is the bullish technical analysis. Here's the bearish technical analysis. I'm going to spare you the agony of watching another 10-minute video of me explaining it. It's here. But there's other trades, right? So getting just aggressively bullish or aggressively bearish, that's certainly one style of trading. It's one of my favorite ways to trade, but it's not what I do every time. There are other things to do. And there tends to be a window for high probability trading right after earnings. So there is a trade, which would last for 1 month after earnings. We call it the 1 month post earnings technical short put spread. So it's just a fancy way of saying getting short a put spread, okay, after earnings. But 2 things have to be true. So I just clicked on a result, Microsoft. First of all, the trade opens 2 days after earnings. So Microsoft had earnings today. I'm actually going to probably do this trade. I'm showing you something that's relevant. So Microsoft had earnings today. 2 days after today is, well, Friday's one day, Saturday's the second day. You can't trade on a Saturday, so Monday's the next day. The point would be to open a short put spread. So selling the 30 delta, buying the 10 delta. If you don't know what a delta is, I'll show you in a second. Okay, so selling a put spread using 30-day options, holding it for 29 days, 30 days, doesn't matter. But only if the earnings move that just happened was up. I have it up 0.1%, meaning it just was up something. That's just a way of me capturing. I don't want to get short a put spread if the stock was down off of earnings, right? I don't want to see the stock go down off of earnings and watch it start trailing down as I've just sold a put spread and I get smashed. So as long as the stock is up something, I'll wait 2 full trading days. Let the stock do all of its gymnastics, up and down, analysts, upgrades, downgrades, blah, blah, blah. Let it be over. Come back 2 days later and look at the short put spread. The technical open just says, hey, the stock has to be above the 50-day moving average. So if the stock is in technical failure, let's say it's below the 200-day moving average, even if it goes up off of earnings, I don't want to sell a put spread. Like if it's in technical failure, I'm not selling put spreads. So that's how you can do it. And if you want to, then now's time to get a little bit into, just note how easy this is, right? I just chose put spread and short and put in my custom earnings and put my technicals in. There are no stops or limits on this. But now it's time. I just want to show you how to kind of stretch yourself within TradeMachine. So we did research on this, and this is in the Discover tab. This had an 81% win rate over the last 10 years. Not in Microsoft, I mean in every the constituents of the NASDAQ 100. This is by far the highest win rate trade we've seen. But, let's remember that it's also a trade that was, if you were to look at the max loss versus the max gain, max loss is going to be much larger when you're selling a put spread, right? So there's no magic bullet in option trading or any trading for that matter. But this is the highest win rate trade we've seen over an extended period of time. 4 out of 5 times it works. And again, if you want to add the alert, you can. But let's take a step back. Why are we only looking at the 30 delta, 10 delta? Maybe there are other combinations. So you can actually change the deltas you're looking at. Sorry, I'll do that again. If you click the settings, here's where you set some of the things that you like to do with trading, kind of personalize it. So this is just set up for 5 contracts. Doesn't actually matter because the results are going to be the same. It's just going to show different dollar amounts. But what you can do here is put in your commissions, because commissions are a part of trading. And so this is the commissions, 50 cents is kind of our default. You can put whatever you want in. And you can also set your own deltas. So I'm going to look at selling selling an in the money put spread, selling an at the money put spread, selling an out of the money put spread, selling a further out of the money put spread, and then selling a way out of the money put spread. So these pairings are sell this option, buy this option, right? First leg, second leg. And I hit save. And now I just need to take my comma out. See that little thing? Now I'm going to see all of the combinations. All right. So this is great because this is exactly what a put spread is, right? You start to see where the sweet spot is. If you sell further in the money put spreads, it's riskier, so the returns should be a bit higher, but your win rate's going to go down. The scan just did the 30-10 delta, but actually the 40-20 delta has shown better return with the same number of wins, but of course it's a little riskier. So you can always feel free to put the settings as you like. Also, always good to know is, how about your fills? Like, are you getting realistic fills? Like, what is this thing doing? So there's 3 types of fills we show, right? So there's mid-market, right? The average of the bid and the offer. Okay, so that's sort of the most optimistic view of option trading. Our community voted on it and wanted this to be the default. I actually was more conservative. Okay, so then the worst version of option trading, or any trading for that matter, is buying on the offer, buying on the ask, and selling at the bid. That's just called a market order. Please don't ever do that for stocks or options. You're just giving money away. A more conservative view of the world than mid-market, but not as unabashedly terrible as market prices, is halfway in between mid-market and a market order, right? So you can choose that and see how it impacts the results. This is a measure of liquidity. And if you recall, I'm now gonna, since there's a lot of numbers here, I'm gonna just go to the 40-20. By the way, it's this middle rung right here that's gonna show if you put a comma, right? So just the 40-20. Okay, so it's 5 wins, 5 losses, 72.6% return. Then I go back to my more aggressive view of the market saying I'll get a mid-market. Results are basically the same. So it's a really good way to see if the options you're trading, or at least historically, if the options in a stock you're looking at are in fact liquid. What if you can't get a perfect fill? Is the strategy still worth it? We try to give you a warning if it's not, but we can't give you a warning for all of them. So you can always toggle your execution fill type, right? Halfway between mid-market and mid-market, things like that, and set your own commissions, okay? So this is a trade before we were buying options, which means we were buying, right? If you own options, you own volatility, right? So option trading is volatility trading, whether you want it to be or not. Right? If you're buying options, you're buying Vega, you're buying volatility. This is selling Vega because you're selling richer options than you're buying back. So this is the opposite, okay? So you're collecting time, you're selling volatility. So this is essentially the opposite. It's still bullish in nature, or at least you could say this is a not bearish trade, right? This would be a bet that Microsoft isn't going to go down a lot. So here's another kind of trade you can look at. And again, you can go to the Pro Scanner and search for all the ones you like. And you can go, let's do it over the S&P 500 and start taking a look at those, right? And you start seeing some familiar names or some unfamiliar names, like Honeywell or United Airlines. Would you have thought of that, right? Another thing the scanner can do, now that I'm kind of stretching your vision of what's possible without trying to overwhelm you, you can actually go by ticker. If you have Chrome, you can do this with the box, but it doesn't matter if you don't. You can actually enter a group of tickers that, let's say you're only interested in 10 stocks. This actually takes up to 100, but let's just say I was a really, particular person. I only like to trade the FANG stocks. We'll do FANG with 2 A's. Right? Just for whatever reason, I'm a finicky dude and I'm familiar with these stocks and I just want to trade. I just want to trade these. Okay. I've just done a scan across all 5 companies across all of our scans, right? And I can sort by ticker or by strategy or simply by the number of wins, or what I like to do is the average trade return, right? So what's been the best trade out of these 5 guys over the last few years? Actually, I'm going to go here and just look at trades that are 3 years and longer. Okay, average trade return. Well, what do you know? It's the buy the dip trigger in Apple. And look what number 2 is. It's the bearish signal we have for Facebook, right? That's the second largest average return. Third one is 1 day after earnings, Apple jump long call. So that has a weird name. And if you go to the Discover tab, you can learn what it is, but I can show you a picture of it. which is this, right? How do you know? So let's say stock rips on earnings. Okay, that happened. The day's over. You didn't get it. You didn't play it. It just happened. Okay, day's over. Now what? When does it happen that the rally continues, right? Same thing on the downside, right? Let me get this image up. What about when a stock misses? When does this happen as opposed to a rally back? Like, is this going to happen for Netflix? Like Netflix bombed, right? The day's over. Would we have wanted to get long puts today at the end of the day? Or would that have been the opposite? So we have a scan to do that as well. So that scan for Apple is the third best trade of these 5 scanning across all the strategies we do. The next one is a Netflix 14 days before earnings trade, right? So you start to get all these. Here's an Amazon bearish trade. So you can start finding the best trades historically for the stocks that interest you the most by just entering the tickers common to limited in there. Or as I generally like to do, I just like to go by strategy. I'm kind of ticker agnostic. Show me something that's liquid and has a good win rate and kind of meets my criteria, 5 years, 3 years, 2 years, 1 year, I'm happy to do it. But people trade differently. So that's the power of the scanner. Everything ends up in the backtest tab. And in the backtest tab, you can always see all the trades. Okay, last thing I'm going to show you. Pre-canned scans are great, right? That's cool. What if you have your own ideas? Right? Let's be free flowing now and say, I don't want to do a pre-canned trade. I want to test my own ideas. Okay. And further, not only do I want to test oh, by the way, this is also a stock backtester. If you just click stock, you can just backtest stock. And further, I also don't want to do just a normal, what people will call kind of the standard option trades, calls, puts, longer short, call puts, covered calls, call spreads, put spreads, et cetera, et cetera, et cetera. I actually kind of have an idea of something I want to do. And I want to try it. So we're going to do it together. We'll click custom and I'll click add. Okay, so what is this idea that I want to test and I want to show you guys? I have an idea that says I want to buy a 30-day call, okay? But I want to sell at the money. But I want to sell an out of the money call every 2 weeks against it to kind of shed some of that risk I have in owning the Vega and owning the option premium, right? And I'm just going to call it a rolling call calendar. Like this doesn't have a, I don't have a great name for it. Rolling call calendar. Okay, so how do I do that? I want to get long and at the money call 30 days. Actually, let's do 60 days. Okay, and now I want to sell a 20 delta call every 14 days. But I want to keep rolling this short call. I don't want to just close this trade after 14 days. I want it to keep rolling. So I'm going to uncheck this box. This box says close all of the legs with the front month options. So if this was checked, this would just do a 50-20 calendar call spread and then just close after 14 days and reopen. No, I don't want to do that. I want to keep rolling this short call against this long call and see what happens. Okay. A rolling call calendar for Aramir, right? There we go. Now it's time to add some stocks. So let's just, for no particular reason, I don't have a desire to do them, but let's just do the FANG stocks because they're liquid and we like liquid stocks. And so TradeMachine is going through thousands of options right now, trying to identify the options that meet it. It's going trade by trade. Oh, there's no such stock as Goggle. Let's try Google. How about that? All right. I have a little four-legged visitor here. All right. My cat jumped on the desk. All right. So Google's going to be talking. Okay. So this is over the last 2 years. Let's really push TradeMachine to the limits and let's encapsulate. Well, so this is, okay. So this is your taste. 2018, the year 2018, January 1 to December 31st, right? That was a down year in the market. So I like to test that year by itself and over a bull market. So let's just do a bull market, which is 3 years. So Facebook, shouldn't surprise us, right? We're in a bull market, things go up, owning calls is good. I mean, so far there's no great aha moment here, other than Google is surprisingly not a good idea. Okay, so Netflix and Google, not good over the last years, so we can kill them. But let's just look. I'm going to manually enter dates. I click settings, and I'm going to manually enter the start of 2018 and then the end of 2018. I want to know this year when the S&P 500 was down, did this work? Was selling those 2-week options to offset my longer term options good enough to get me back the rallies? And it turns out in Amazon, that's the only time it was, right? So Amazon has this incredible, there's a guy on Twitter who calls Amazon his secret wealth creator. He has a secret strategy. And he said, what's your secret strategy? He said, buy calls. So that's a bit of a risk to just buy calls naked. But it turns out if you own calls long enough, 60-day calls on Amazon, and you're offsetting it by selling 14-day options, it was a winner even in a point where the stock didn't do that well, right? So, and then clearly the results over the last 5 years, 10 years, 6 months. And we can actually see over the last 6 months, right? For the last 6 months, 12 wins and 2 losses. So this is a strategy which is custom that I've built, and now I can test it. Oh, I should also do never trade earnings probably. All right, even better. You want to do never trade earnings because otherwise you're entering this trade in the middle of an earnings. That's basically making an earnings bet, but why make an earnings bet? That's a totally different kind of trade. So I've done this before, so I kind of knew what the results would be. But yeah, if you're looking for a trade that kind of rolls every couple of weeks, for the last 10 years, 5 years, 3 years, 2 years, then specifically 2018 and the last 6 months, and avoiding earnings, yeah, this 50-20 diagonal rolling the 14-day options call spread in Amazon has been a winning trade. It's been a winning trade over basically all markets. We can't really test it during the Great Recession because Amazon was a different company during then. We can try, I'm just curious, but another thing is I don't think these options existed in 2009, so we might get an error, but let's just say, yeah. So this says the strategy is a problem. The options selected result in multiple legs attempting to open the same trade. That's because there weren't weekly options back then. So that is the end of my presentation. I hope that what you've learned is that there are a lot of ways to trade options, a lot of strategies you can check, either strategies that we've pre-built or ones that you can do on your own. And there are ways to check their robustness. While I answer questions, I'm going to put this up. There is a special for Arrowmere right now. A trade machine is month to month, so you don't have to commit, $1,000 or whatever. If you go to cmlviz.com/arrow, you will see a $109 a month subscription rather than the normal $199. And just so you know what that page looks like, to make sure you landed on it, it just looks like this. Pretty simple page. You'll see the dual logos. Here's the confirmation of the price. You can watch a movie. You'll learn even more. And that's it. So what do you get with the subscription? Well, you get Trade Machine, but I also send out 3 articles a week, which I find to be relevant. They're not necessarily trades for now. They're just things that I found. What did I just send? I just sent that pattern in Microsoft where selling that put spread, if you wait 2 full days after earnings and the stock was actually up after earnings. So I just sent that out to members. Not everyone does. These are not trade recommendations. We can't give advice, and not everyone uses them. But they can start helping you. They can start help you build out your alerts, which is kind of the goal. They're not necessarily actionable immediately, but that's what they're for. So,
yeah, we had a few questions. A nice presentation. Let's see. There was one from Dave McGalliard who said, do you have plans to add indicators other than moving average and RSI to the custom technical open screen?
Yeah. So one of the clear places for improvement in Trade Machine is to add more technical indicators. The reason we don't have them yet is because I was unable to show that they added any value. I mean, no offense to anyone. I'm just looking at the results. I'm not trying to make an opinion. I'm just like, I'm doing back testing and I'm looking at if there's a statistically significant difference. Having said that, I didn't try a lot. So yes, I would expect more technical opens to be there, but we're pretty rigorous about what we add.
Sure. Rick asked, can you show how to do a 10-day expiration / 24-day expiration calendar holding for a 7% profit or out in 2 days in SPX?
Yeah, let's do it. You'll have to repeat some of that, but let's do it right now. So This can be a custom strategy. All right. So first it was, what am I getting long?
Let's see, doing a 10-day expiration and 24-day expiration calendar.
We'll just use the at the monies, I guess. I don't know.
Yeah, he didn't say.
Okay, so 10-day getting long and at the money call, 10 days to expiration. And then what am I getting short? Sorry.
The 24-day.
Okay, getting short 24-day. Now remember, TradeMachine does not invent options. If there's no 10-day option, it doesn't create a hypothetical option. It's going to find the option closest to 10 days and the option closest to 24 days. Okay, so we'll call this the
1024 calendar or something.
Right, 1024 Cali. Okay, okay, and then we had a close rule, right, which was after 2 days or something.
Yeah, hold for a 7% profit or out in 2 days.
Okay, so I'll put my limit of 7% and close the trade after 2 days.
2 days.
No matter what.
Right.
Okay. And we want to do an SPX. I'm going to do SPY, which is close enough. You can do SPX. SPY is just so many options. It takes a really long time to load the data. So those look great. I'll do 3 years. I mean, I'll do it as though I'm analyzing. Right. So this strategy doesn't look great. This strategy does get short deltas because, well, it's a bearish strategy in the sense that you're getting short options.
Well, don't you want to sell the 10-day and buy the 24-day?
I could, that's what I would have done. I can try. So here, I'll just reconstruct it. I'll get long the 24
and short the 10.
Yeah. Oh, I don't know if did I save it? No. Okay. Sorry. Short. Add. Save. Okay. Yeah. So that looks like a beauty, right?
That's working.
Let's get everyone doing that trade. Yeah. So unfortunately, who asked this question? What was his name?
Rick.
Rick, I'm going to steal your strategy. So 7% limit, close it after 2 days maximum. It was getting long a 24-day call, getting short a 10-day call. With some pretty strict rules, so no more than a 2-day trade. These are trading days. And yeah, it's a phenomenally good trade, actually. Okay, actually, but look, the last 6 months, because we've been bumpy, I thought that might happen because the last 6 months we've been a little bumpy. So, but generally I love this trade. Yeah, it's pretty cool.
And I noticed under the custom, there's a drop down. So it looks like you can save multiple custom strategies.
Oh yeah. I have many. Yeah, you can save unlimited. There's no limit to how many you can save. We don't limit you. Yeah. So you can see I have a bunch of trades that I do. Those are my little secrets. So yeah, absolutely. Like customs, it's all about custom strategies options. It doesn't have to be. I mean, feel free to just use the scanner and use those. And, I do that a lot, but every once in a while I like to try to kind of get an ongoing trade, something like that Amazon trade or something like, even like this SPY trade. So.
And your earliest date for data, is that in 2007?
Right. We go Jan 1, 2007 through today. Just grows every day. Yeah.
Okay. And any plans for adding like futures or commodities?
Probably at some point, but I wouldn't sign up for TradeMachine because you think it's coming soon. So this is how TradeMachine works. This used to be a $49 a month product. And we just kept adding and adding and adding and adding and adding and adding, like technicals and earnings and scan. We didn't even have a scanner tab before, or a discover tab, or alerts. We didn't have alerts. So as we add to it, the price goes up. Now, price never goes up for a current member. So if you're a member, you won't pay. So I feel like I can safely say thousands of members at $49 a month who are probably loving the upgrades, right? Yeah. And we have, people come in who are now paying $199. So we continue to do it. Eventually, TradeMachine is going to cost $6,000 a year. Eventually, it's going to be $499 a month. So $500 a month. But your price never goes up if you sign up and you stay a member, you never see it. So, you can see advertisements for the TradeMachine price going up and you just look at it and go like, yeah, not me. So we do that, not because we just raise prices. It's when we add the value, right? We start adding technicals, we add more technicals, we add other securities. But other securities is pretty far down the pipeline. Other things that are more likely are like IV rank or more technicals, things like that. Or even, in all fairness, even more moving averages. Like this is not a comprehensive list of moving averages. Even if you're just going to go the moving average route, you probably want a 5-day, 8-day, and 13-day. So even that's, coming. So
I think there was a discussion in the forum about the Thinkorswim moving averages didn't match the ones in TradeMachine.
Yeah, for sure. So I think Thinkorswim is fantastic. So I'm not trying to disparage anything. In fact, if I didn't have
what I'm about to show you, I would be using Thinkorswim. But I'm a stickler for accuracy. I didn't really go over my bio. You guys can, you know, you can do it the old-fashioned era. Just type Ophir Gottlieb, Capital Market Labs, about, and blah blah blah. Okay, this is me, by the way. so I'm a mathematician by trade. Okay, so I'm pretty particular, and the way data vendors use moving averages is not strict enough for me to put my money on it. Okay, right. So for example, Thinkorswim, they don't use adjusted prices. And in my opinion, using adjusted prices is critical to having proper moving averages. What's an adjusted price? Well, the obvious adjusted price is a split, right? That's when Netflix used to split 7-for-1. It used to be $700 stock, went to 100. So you definitely want to have those adjusted, but Thinkorswim definitely does that. But sometimes there are dividends, and Thinkorswim does not adjust for them. And when it does or doesn't is a little bit confusing, to tell you the truth. And I can't be confusing if I'm going to trade. So we have adjusted stock prices. That's one reason it's different. The other reason it's different is because we have intraday, real-time, live moving averages. So movingaverages.com is our property. I've created it for TradeMachine. It's free. So even if you don't sign up for TradeMachine, these moving averages adjust in real time. And they're here on the side too, so you can see them. So you can see if something's about to trigger, like what prices it has to get to, right? So this is Apple. It just crossed its 10-day moving average today, right? It was up 231. Yeah. So Apple just got to stacked moving averages today, right? Netflix, like how bad is Netflix? Netflix just crossed through its 200-day moving average. By the way, if you guys are wondering, remember I said, hey, when Netflix crashes off earnings, is that a good time to buy it or to sell it? I'll show you something pretty interesting. If you look at Netflix, get long a call, but only do it when the day the stock price crosses down through 200. So only do it when the stock is collapsing. Look at that. So I actually just got short Netflix like the old-fashioned way. I borrowed stock and sold it today. So I saw this and my gut sank a little bit, but I'm not looking to make a 30-day trade.
Yeah.
But just so you guys know, this stock tends to rally hard when it hits that 200-day, below the 200-day moving average, which is definitely contrarian, you know. But anyway, so the prices are different from Thinkorswim because we use adjusted prices and because we're real time. And if you ever want to know what prices we're using, we created movingaverages.com. This is just moving averages. So there's no black box about TradeMachine. You can see it explicitly. This is the engine that's powering this scatter plot is powering TradeMachine. It's the same web service.
So I guess along those lines, there's a question: do you open the next trade immediately? At what time do the trades happen? So you get an alert, do you put it on right now or the end of the day?
No, so all trades in TradeMachine, all triggers, all opens, closes, stops, and limits are end of day.
End of day, okay.
So 15 minutes before the close. We remind you of that, by the way, every time we send a dossier. So today I just sent this thing about the pattern right after earnings in Microsoft. Blah, 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 lots of words, blah, blah, blah. Oh, where is it? Oh, I didn't put it in here. The one time I didn't. So let me just go to the Twilio one. This is a pre-earnings trade in Twilio that I really liked. Here, we'll have it here every time. The mechanics of TradeMachine are that it uses end of day prices for every backtest entry and exit, every trigger. So if you get an alert that says, let's say you got an alert today that Netflix went below its 200-day moving average, and you're like, oh, well, I want to get long when that happens because you want to play the contrarian thing. But let's say it was close, right? So if we look here, it actually isn't. It just totally ripped through it, right? That's $13 through. But sometimes you get things that are really close and you don't know. The trigger is not when you get the alert. The trigger is at the end of the day, only if that technical requirement is met. So let's say you got an alert. Hey, Netflix is below the 200-day moving average. Like, all right, I'm going to get long. By the end of the day, so the 200 days, 337. By the end of the day, if Netflix had crept up to 338, that trade's off. No trigger. No trigger.
Okay. Right. Let's see. There's a couple of questions about different technical analysis indicators, but I guess you kind of talked about that already. Tanya asked, have you done any forward testing?
What is forward testing? I wish, believe me, if I had the future, I would test on it. Actually, I just use it. I wouldn't even test.
Yeah. It's like Back to the Future. You get the sports almanac, right? So.
Oh yes, give me this exactly. As every trader's ever said, just give me 1 hour, one time. But don't ever think that way. It's actually very dangerous to think that way because it's never going to happen and it's just poisonous. So don't think that way.
Okay, and John Dory, I guess he's a subscriber, but he didn't receive the Microsoft email. So maybe, John, if you contact Ophir's team, I'm sure they can sort that out.
Support at CMLViz. But you would just check your spam folder. I mean, that's most commonly what happens. So
yeah. Well, I think that's. Oh wait, and John said, another John, can you review the rules for that 1024 calendar system? I'll just quickly sell the 10-day, buy the 24-day, and hold it for either a 7% profit or you're out in 2 days, and that was SPX.
Right.
That was it.
That's right.
So if you really appreciate it, like I said, I've been watching you guys for a number of years, and the product's really grown and matured, and I'm sure it's going to continue so because it's been very successful. And I look forward to seeing what you come up with in the future. I hope everybody listening to this, if they're not doing the special rate, it's a great research tool, like we were talking about in our trading group. That people use this to find trade candidates, and then if they want to use something like Option View or Option Explorer, go back and manually back test it to kind of get a feel of how it works. But this is a great tool to quickly find those types of trades that you want to spend time manually back testing.
Yeah.
So thanks again. Really appreciate you coming on, and it was a great webinar. So thank you so much.
My pleasure. Thanks for inviting me, and thanks to all the participants for taking the time to listen to me. So have a great night, guys. Have a great weekend.
All right. Take care.
Right.
Bye. And good luck on the wedding.
Wow. Thank you very much. Thanks, Tom.
All right. Bye-bye.